My name is Kim Mahanna. I'm a principal at Smith Schafer Associates. I lead the transportation group in our firm. Have been working with the transportation industry for in excess of 30 years now. Today we want to talk about 4 specific items that impact our transportation clients. The first is the overview of the Tax Reform Acts and how it impacts our transportation clients. The second are 2 Minnesota revenue tax bills and their impact. The third is planning for depreciation for our clients. And the fourth being qualified business deduction for our pass-through entity clients. As you know, the federal and state of Minnesota have begun making it a habit of doing retroactive tax law changes. Nothing has changed in that regard. They still are doing the retroactive tax laws. As a result, in December 22nd, 2017, the Tax Cuts and Jobs Act, enacted by the federal government, came into play and rolled activity and tax law changes back to September of 2017. In May of 2018, the Governor Dayton vetoed the Minnesota tax law bill, and in May 30th, 2019, Minnesota adopted a conformity bill with a portion of the federal law being brought into Minnesota law. So what does that mean for our clients? That means we filed 2018 tax returns under a law where the federal government said one thing and the state of Minnesota said something else. Ultimately, in May of 2019, with the conformity bill that was adopted by Minnesota, they rolled that back to 2018. So where we're left is Minnesota changed their mind 5 months after the end of the year and rolled it back effectively 12 months plus the 5. So where does that leave us? For our C Corp tax clients, and we have many in the transportation industry that choose to use that form of entity, they're left with a 21% federal tax bite on their net income. There's no longer brackets associated there. It's a single bracket. Minnesota is left with 9.8%. Individuals, which are paying the tax on all of our pass-through transportation entities' income, ends up with 7 individual federal tax brackets: 10%, 12%, 22%, 24%, 32%, 35%, and a top bracket of 37%. Further complicated by net investment income tax that is added on top of those. In Minnesota, the individual rates run anywhere from 6.85% all the way on up to 10% individually. Okay, why don't you talk about depreciation? Where does that leave us with Minnesota adopting the federal or conforming to the federal? Federal depreciation has pushed forth for late 2017 and all of 18 and now 19 and 20 a bonus depreciation that effectively takes a piece of equipment and allows you to write off the full cost of that piece of property in a single year. The problem is that you have to do the whole class. So that if you're dealing with school buses or motor coaches, as an example, those are in a 5-year class and you have to elect all of the class to take that. What does that mean? That means that we have an impact on the individual return that reports the pass-through income either from an S Corp or from a partnership or a proprietorship. That may actually cause a loss in the individual's return, which might not be the desired effect. So we have to elect in or out of bonus depreciation, 100% bonus depreciation on a class-by-class basis. What does that mean? That means we leave you with some complexities that we have to determine as we're preparing your individual returns. Now, we still have the ability to do Section 179 for equipment for federal, but it's limited once you hit additions to fixed assets in excess of about $2 million. Minnesota, they've made it nice and simple now with the conformity laws, is that they're forcing us to add back 80% of the bonus depreciation and the Section 179 in excess of certain limits. So our fourth topic is qualified business deduction. Because transportation industry is not in a service, sure seems like a service, but it's not one of the specified services that has some curtailment. So it doesn't matter the magnitude of the profit made by the transportation company, there's a qualified business deduction there equal to 20%. So what does that mean? When we have a net income of, I'll use it as an example, $100,000 net income for a transportation pass-through entity, the individual, as long as they have enough in wages paid to the individuals working for the company, they will get a 20% deduction. So as a result, we want to be able to take advantage of that 20% deduction for our transportation pass-through entities, and accordingly, we may pull back on some depreciation in an attempt to get greater 20% deduction. Thank you for watching the video today. We are experts in the transportation industry and we're here to help. If you have any questions, please contact us at Smith Schafer and our transportation team. Anybody you call within the organization at the front desk knows who to forward the data to or the information to as to what you might need. We're happy to talk with people, even if they're not our clients.